Hello friends, welcome to the book summary. In this video, we will see the 5 important takeaways from the book One Up on Wall Street written by Peter Lynch. Before entering the book summary, kindly like the video and subscribe to our channel. Book's link is given in the description. You can buy it from Amazon. Let's start. One Up on Wall Street is a classic investment book written by Peter Lynch, a renowned investor. Here are 5 important takeaways from the book. 1. Invest in what you know. Lynch emphasizes the importance of investing in companies and industries that you understand. By leveraging your knowledge and expertise, you can make informed investment decisions and have an edge over other investors. Invest in what you know means that investors should focus on companies and industries that they have a good understanding of. By leveraging their knowledge and expertise, they can make more informed investment decisions and have an advantage over others who may not possess the same level of understanding. Here's an example to illustrate the concept. Let's say you work in the technology industry and have a deep understanding of the latest trends and developments. You are familiar with the products, services, and competitive landscape within the industry. Applying the principle of invest in what you know, you might decide to research and invest in a technology company that you believe has strong growth potential. By being knowledgeable about the industry, you can assess the company's competitive advantages, evaluate its product offerings, understand its target market, and gauge its potential for future success. This familiarity can help you make more accurate predictions about the company's prospects, giving you a better chance of making a successful investment. On the other hand, if you lack knowledge in a particular industry or company, it may be more challenging to accurately assess its potential. Investing blindly in industries or companies that you don't understand can increase the risk of making poor investment decisions. In summary, investing in what you know involves utilizing your personal knowledge, expertise, and insights to make investment choices. It allows you to make more informed decisions and potentially identify attractive investment opportunities within industries or companies where you have a competitive advantage. 2. Do your own research. Lynch encourages investors to conduct thorough research and analysis before making investment choices. He advocates for a hands-on approach, visiting stores, talking to customers, and studying financial statements to gain a deeper understanding of a company's potential. Do your own research emphasizes the importance of conducting thorough analysis and investigation before making investment decisions. Relying solely on others' opinions or recommendations can be risky, as it may not align with your individual investment goals or risk tolerance. By conducting your own research, you can gain a deeper understanding of the company, industry, and market conditions, enabling you to make more informed investment choices. Let's say you come across a company in the pharmaceutical industry that seems promising. Before making any investment decisions, you would start by conducting your own research. This would involve various steps, such as 1. Studying the company's financial statements, analyzing the company's income statements, balance sheets, and cash flow statements to assess its financial health, profitability, and growth prospects. 2. Investigating the industry and market conditions, researching the pharmaceutical industry as a whole, understanding the market dynamics, competition, regulatory environment, and any potential upcoming developments that could impact the company's prospects. 3. Assessing the company's products and pipeline, evaluating the company's product portfolio, researching its pipeline of new drugs, and understanding their potential market demand, efficacy, and competitive advantages. 4. Reviewing management and leadership, examining the company's management team, their track record, experience, and strategic vision, as well as any notable achievements or concerns. 5. Examining competitive positioning, analyzing the company's competitive position within the industry, considering factors such as market share, barriers to entry, intellectual property, and partnerships or collaborations. By conducting thorough research, you can gain insights into the company's strengths, weaknesses, opportunities, and threats. This information will help you make a more informed investment decision based on your own analysis and understanding, rather than relying solely on external opinions or recommendations. Remember, research is an ongoing process, and it's important to stay updated with the latest information and developments in order to make well-informed investment decisions. 3. Look for hidden gems. Lynch believes that some of the best investment opportunities lie in small and lesser-known companies. These 10-baggers are stocks that can multiply their value several times over, offering significant returns. By identifying these hidden gems before they become widely recognized, investors can benefit from their growth potential. Look for hidden gems refers to finding investment opportunities in lesser-known or undervalued companies that have significant growth potential. These companies are often not widely recognized or followed by the mainstream market, which means their true value may be overlooked or underestimated. By identifying these hidden gems before they gain widespread attention, investors can benefit from their growth and potentially earn substantial returns. Here's an example to illustrate the concept. Imagine you are conducting research on the retail sector, and during your analysis, you come across a relatively small company that operates a chain of specialty stores. This company has a unique niche, offering products that are in high demand but have not yet gained significant popularity in the mainstream market. Through your research, you identify several promising factors. 1. Undervaluation. Despite the company's strong financial performance and growth potential, its stock price remains relatively low compared to its peers in the industry. This suggests that the company may be undervalued by the market. 2. Growth opportunities. You discover that the company plans to expand its store locations, introduce new product lines, and tap into new market segments. These growth initiatives indicate the potential for increased revenue and profitability. 3. Market niche. The company specializes in a particular category of products that is gaining traction among consumers. While larger retailers may not have fully recognized the trend, the company's focused approach and expertise give it a competitive advantage in meeting the unique demands of this niche market. 4. Strong financials. The company's financial statements reveal consistent revenue growth, improving profit margins, and a healthy balance sheet. This indicates that the company is well positioned to capitalize on its growth opportunities. By recognizing these factors and considering the company as a hidden gem, you may decide to invest in the company's stock. As the company's growth potential becomes evident and more investors take notice, the stock price could appreciate significantly, providing substantial returns for those who identified the opportunity early on. However, it's important to note that investing in hidden gems carries risks, as they may be associated with smaller market capitalization, lower liquidity, or higher volatility. Thorough research and analysis are crucial to ensure that the investment aligns with your risk tolerance and investment objectives. The key takeaway is that by actively seeking out undervalued or lesser-known companies with strong growth prospects, investors can potentially uncover hidden gems and benefit from their future success. 4. Long-term investing. Lynch advocates for a long-term investment approach rather than trying to time the market or make short-term gains. He advises investors to focus on the fundamentals of a company and its growth prospects over time. By staying invested for the long haul, investors can benefit from compounding returns. Long-term investing refers to an investment strategy that focuses on holding investments for an extended period, typically years or even decades, with the goal of capitalizing on long-term growth and compounding returns. It involves a patient and disciplined approach, where investors prioritize the fundamental qualities of an investment and the potential for sustained growth over time, rather than attempting to time the market or make short-term gains. Here's an example to illustrate the concept. Let's say you decide to invest in a well-established technology company that you believe has strong growth potential. You have thoroughly researched the company, analyzed its financials, studied its competitive advantages, and evaluated its long-term prospects. Based on your analysis, you are confident that the company's innovative products, strong management team, and expanding market share position it for significant growth in the coming years. Instead of trying to make quick profits by trading the stock based on short-term market movements, you choose to adopt a long-term investment approach. You purchase the company's stock with the intention of holding it for the next 10 years or more, allowing it to benefit from its long-term growth trajectory. Over the years, the company continues to innovate, releases successful new products, expands into new markets, and captures a larger customer base. As a result, its stock price steadily appreciates, and the value of your investment grows. Additionally, the company may distribute dividends to its shareholders, further enhancing your returns. By adhering to a long-term investment strategy, you avoid getting swayed by short-term market volatility or noise. Instead, you focus on the company's fundamental qualities and its ability to generate sustainable growth over an extended period. This approach allows you to potentially benefit from compounding returns, as the gains you make on your investment are reinvested over time, generating even more returns. It's important to note that long-term investing requires discipline, patience, and the ability to withstand market fluctuations. Investors should regularly review their investments to ensure that the underlying fundamentals remain intact and align with their long-term goals. Long-term investing is particularly suitable for individuals with a longer investment horizon, such as retirement planning or wealth accumulation over several decades. In summary, long-term investing involves holding investments for an extended period to benefit from sustained growth and compounding returns. By focusing on the fundamental qualities of investments and avoiding short-term market noise, investors can potentially achieve significant returns over time. 5. Be patient and stay disciplined. Successful investing requires patience and discipline. Lynch cautions against being swayed by short-term market fluctuations or trying to chase quick profits. He encourages investors to stick to their investment strategy, ignore the noise, and stay focused on the long-term goals. Be patient and stay disciplined emphasizes the importance of exercising patience and maintaining discipline when it comes to investing. It implies the need to avoid impulsive decisions driven by short-term market fluctuations or emotional responses and instead stick to a well-defined investment strategy and long-term goals. Here's an example to illustrate the concept. Let's say you invest in a diversified portfolio of stocks with a long-term perspective. After careful research and analysis, you have selected a mix of companies across different industries that you believe have strong growth potential. A few months after making your investments, the stock market experiences a significant downturn. Many of the stocks in your portfolio decline in value, and it's natural to feel anxious and tempted to sell your holdings to mitigate potential losses. However, if you have a patient and disciplined approach to investing, you would resist the impulse to make hasty decisions based on short-term market volatility. Instead, you would remind yourself of your long-term investment strategy and the thorough research that went into selecting your portfolio. You understand that market downturns are a part of investing and that the market tends to recover over time. Rather than panicking and selling your investments at a loss, you stay disciplined and maintain your long-term perspective. As you exercise patience, the market eventually begins to recover, and the stocks in your portfolio rebound. Over the course of several years, the companies you invested in demonstrate their growth potential, and the value of your portfolio starts to increase. By staying patient and disciplined, you have allowed your investments to recover and benefit from the long-term growth potential of the companies you chose. Selling during a downturn would have crystallized your losses, and you may have missed out on the subsequent market recovery and the potential for substantial gains. The example illustrates the importance of remaining patient and disciplined during challenging market conditions. It's crucial to remember that investing is a long-term endeavor and that short-term market fluctuations are temporary. By staying disciplined and adhering to your investment strategy, you increase the likelihood of achieving your long-term financial goals. It's worth noting that being patient and staying disciplined doesn't mean being passive. Regularly reviewing and reassessing your investments, rebalancing your portfolio if necessary, and staying informed about market trends are all part of maintaining a disciplined approach to investing. These takeaways from One Up on Wall Street highlight Lynch's emphasis on doing thorough research, investing in what you know, and maintaining a long-term perspective while being patient and disciplined throughout your investment journey. Thank you for watching. Kindly like, comment and share this video with your friends and family. Don't forget to subscribe our channel. Book's link is given in the description. You can buy it from Amazon.
The Financial Freedom is the book written by me. In this book, I explained the pillars of personal finance and step-by-step guide to achieve the financial freedom. In this book, I have explained how rich get richer and poor get poorer with examples. Also, I have explained how much money required to achieve financial freedom using 4% rule. This book's link is given in the description. You can buy the book using that link.